this does bring us to our next question. And this came from Jake on Thursday. He's a new Power Options user, Power Options Trial Member. And he says, I missed out on some of the upward move. He got in mid-December, trading some call options, trading some stocks, doing some covered calls. He says, I have fears the market is overbought, and I keep seeing bearish sell when I log in. Many are saying it will continue to go up and up, and others are saying we're still going to possibly face a recession and maybe a depression. There's someone out there who's even claiming that the market, I believe, could drop 40 to 55% in the next year from its recent highs. And at that time, he was saying the recent highs were 4,500, and here we are at 4,768. But the idea is, how can I take advantage of further upside and not miss out again? The FOMO, fear of missing out. But know I am making the right moves. Well, let's go ahead and go over to Power Options. Related to Jake's question, the married put approach. The married put approach is a common approach. It's a way of trading stock with having insurance on the position. Hey, I buy shares of stock I'm interested in holding. I think it's going to move up 5 to 6% in the next 20, 40, 50 days. But at the same time, I don't know, things have been iffy. Volatility is high, not now, it's near the low it has been in several years. But I'm concerned about certain things, and I don't want to get caught with another position that I thought was a no-brainer and ended up holding a bag, taking a 20% loss, 15% loss in the position. I don't want that. So let me go ahead and buy a stock at 50. Let me buy a cheap 40 strike put 1 month out in time for 80 cents or so. And, I'll have some protection in place. Well, that's still a risk of 20%. The insurance doesn't kick in. And it only lasts for 30 days. You want to keep protecting that position, holding for long term. You got to buy another put and buy another put and buy another put. And what do we know about options? Well, when you're selling premium, do you want to sell week by week or month by month to get a better annualized return? The reverse is also true. When you buy protection or you buy insurance, you want to buy further out in time, because the option that is 6 months out in time at the same strike on the same stock is not 6 times the price. You get a lower annualized cost buying further out on a time on a stock you want to hold long term for projected growth. Even if I only think it's going to go up for 2 to 3 months, I want that protection in place for longer term, because it's going to cost me less per day than buying 1 month, 1 month, 1 month, 1 month, and 1 month, even as the stock fluctuates in price. The advantage of the preferred married put technique discussed in the blueprint is following the 3 core principles. We're going to buy shares of stock, buy a put that's several months out in time, at least 5 months out in time or more, slightly in the money to control risk to a guaranteed exit of single digits. I was looking at this one earlier, actually. I kind of hesitated now with that mention I made of the sniffles and the sneezes and the coughs upstairs, and some of my friends saying they're not going to make certain holiday gatherings due to kid sickness or house sickness, and flashbacks to 2021, 2020, things of that nature. But hey, it's the season. Flu, cold, everything else now as well. But I was interested in Carnival a little bit, taking a look at this married put trade today. A nice bid-ask spread, even though I'm going out to January 2025 at the 22 strike. 485 ask, 490 mid, 495 ask price. I'm sorry, 485 bid, 490 midpoint, 495 ask. Well, the structure I would use in this case, Jake, is I might buy shares of stock of CCL at 1893. At the same time, I might buy that 2025 January 22 strike put, let's just say at 490. That's pretty possible to get that midpoint with that tight of a bid-ask spread. So now my total investment is $23.88. Stock trading at $18.93. That doesn't make any sense. I want to buy cheap insurance, don't I? But the maximum risk is only the time premium, $1.88 or 7.9% of the total investment into the trade. Let's take a look at the profit and loss chart for that position. As I mentioned, the married put gives us a guaranteed floor, a controlled risk that cannot be violated. If CCL fell to $5 per share, I'm guaranteed that I can force someone to buy that shares of stock for me at $22. The most I can lose at midpoint is 7.7%. Oh, but my break even's up to 23.83. I invested 23.83 in a position. I'm not going to make a dime until the stock moves up 5 points, $4.90, the cost of the put. No, because of the proper structure, the put does not decline 1-to-1 with the stock. Put doesn't go to zero the minute I buy it. If the stock moves up 50 cents tomorrow, I'll likely have only a 20 to 30 cent drop in the put strike price. Maybe only 15 to 20, really. You're expecting to still make 50% of the unrealized profit in the stock as the stock moves up in price, because the put's only declining maybe half or less, maybe a little bit more, 60%, 50%, or 40% of the gain in the stock price. It's a bullish strategy, but with a controlled risk. So Jake, to your question, the structure that we advocate, that I've been using with, about 45 to 55% of my portfolio, I've been talking about for years and years, and educating for years and years, and pointing people to the full course, the blueprint, for years and years, and Ernie's trading with about 80% of his portfolio, maybe a little bit more, as he's well into retirement, doesn't have a lot of spendable income coming in. What does this structure just do for me? As we mentioned, we're hitting new market highs. And, we heard the earlier question related to, hey, Elliott Wave is saying we're going bullish, 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 bullish. You guys are saying bearish, bearish, bearish. But, everything is pointing to bull, bull, bull with the Elliott Wave, 2 days ago, 3 days ago. And SPY is still running rampant even after that last little hesitation we had shortly after that, where the market sentiment was showing bearish, by the way. Just throw that in again because I can. Excuse me, folks. But where are we at? Jake said that he got in here. Oh, I'm sorry. Let me scroll down a little bit more. Let me take some of this out first. I'm going to take out the Bollinger Bands. I'm sorry. I take out the RSI just for a moment, and the volume. Get a better chart view here on our screen with the dates. Yeah. So Jake had mentioned that he got in at, he was, these runs here, this move up here, he sort of missed. And he got in sort of around it here. Not too bad at all. Now he's doing pretty good, but he missed out here. Maybe he traded earlier and didn't tell me, and he got in around these points right before this decline. And then maybe he was hesitant, missed out here, said, you know what, I've got to jump back in. Oh, no, now it's doing it. Now it's doing it. Oh, I got to jump back in. Well, now I'm in, but if I expect it still to go up, what can I do to get in to see more of the profit that I'm expecting and hoping for, but not see this again? Not see some of those trends we saw earlier in the year when the market sentiment went to bearish sells, and we saw that 7.5% drop after the 9.4% run, and then we saw that 10.2% drop after the 18.4% run. It's not about timing the market necessarily. Yeah, I want to have good timing. I want to be able to time the positions correctly. I'm going to use things like MACD and things of that nature. The market sentiment tool, we just talked in depth about that. But it's not just about market timing. It's about trade structure. And it's not about timing the trades. It's about trading time. This break even that I mentioned, this, why are you paying so much for this put to increase your price? Honestly, I don't care about that. My plan is not to hold this position all the way to January expiration and hope the stock is above 23.83 to make 5 cents, 10 cents, or 15 cents. No, I'm going to be manipulating this trade, doing income methods against it, selling calls, doing spread trades inside this protected position that doesn't add to the risk. I'm going to manipulate the put, which is a second working asset. Why am I going out to January? Hey, it's one of the 3 core principles of radioactive trading and really any trading. We already talked about it. Time decay curve. This is maybe 30 days out in time. This is 60. This is more around 90. It's about 120. And then this is about 150. Maybe 210. Maybe 300. And yeah, it's not a perfect drawing, obviously. But the idea is that this 183 that I invested in the position is all-time value. The remaining cost of this is the intrinsic value that it's in the money. I'm guaranteed to get that back. That roughly $3.07. I'm guaranteed to get that back because I paid $18.93 I'm buying the 22 strike, so I'm paying $3.07 for that in the money intrinsic value, which I'm guaranteed to get back. Even if 392 days away from now, CCL just remains at 1893 and never moves, my put's still going to be worth that 307. I can get out at 22, no problem. I've only lost 183. But if I paid 183 for a 60-day output, I'm going to see that time value decay rapidly. If I paid 80 cents for a 17 strike put, for example, on CCL for the next 30 days, I'm going to start seeing that decline almost 2 cents per day. This is going to be much, much more gradual until I get into this range. But all in this time, I'm using this time value to manipulate the position, adjust the put, the second working asset, while selling calls against the position and doing more. You've forced yourself into an ideal size trade. You still have unlimited upside to begin with the availability to generate income, reward yourself for picking the right stock. And you have a second proper working asset that is not decaying rapidly in time value as a cheap 30-day out option, just maybe throwing away money for, because the stock has to drop 2, 3, or 4 points before that cheap insurance kicks in. So you're losing that, plus the price you paid for the put. Your risk can actually be higher 20 to 30 days out with a 17 strike put here or a 16 strike put because of how far the stock needed to drop before the insurance policy kicked in. You can see that if I bought the 17 strike put right now on CCL, paid let's say 60 cents for it, the stock has to drop $1.93 before that insurance kicks in to help me. And I paid the 60 cents for it. That's a 1 month out risk of the 193 plus 50 cents. That's way higher than the 183 I'm risking, and I'm locked into for 392 days. That's the initial purpose of our married put structure. You don't have fear of trading. Even though I think we might be at a market top and there's a bearish sell coming, if I enter a position right now, even if the first 15 to 20 days from now, the markets pull back 5, 7, 8%, okay, I'm going to be losing on the position, but you know what? My liquidation loss would only be 2, 3, or 4%. And what do I have? I have a gain in that second asset. Stock falls down to 17. This 22 put is going to go still 390, 380, 375 days out in time. Let's just take a look. What would our put theoretically be worth? We drop down to $17. This is a fair drop, of course, from 1893 percentage-wise. Well, let's just say it happens. On a profit and loss chart, we're going to run this scenario. Let's say it's 25 days out, 16th of January. Stock CCL falls to 17 when I enter this position. Yeah, I'm going to be down 193 on the stock, but I'm gaining half of that back on the put as I expected. Only down $95. Half of the maximum risk on the position. Our maximum risk was 7.7%, so we're looking at a loss of 3.8%. What can I do with this 95 expected profit I might have in this put? I can take that off the table. Lowers my cost basis down by 95 cents. I can move down to a lower strike, cheaper put, maybe the 18 or the 19, still have a controlled risk, but have a reduced cost basis in the position possibly. Those are some of the income methods. That's how that blueprint works. It's not just the structure and how to use it, how to set it up, how it protects you, avoids the fear of missing out in those cases. But what it allows us to do is avoid what you talk about. Take advantage of further upside without fear of missing out and having ways to manage the position because you started off properly with a controlled limited risk. You're not even going to realize that full loss unless the stock drops 35, 45, 50%, or you hold it all the way to expiration. Do no adjustments on the position, which you have the availability to do for 392 days, except no dividends if the stock pays a dividend, and the stock remains below 22. That's the only time you're really going to realize that full 7.7% loss. That's how you avoid the fear of missing out in the market, planning on further upside potential, but not getting hurt if the market does decide to have more of a breather, more of a correction than you anticipated, and you're not going to get stuck holding the bag. Yeah, you're taking a 7% risk, but that's insurance out 392 days. you can manipulate this structure, this protected married put structure in the proper format, going far out in time with the proper selection in the money. Why? Yeah, that's discussed in the blueprint, why we do it this way as opposed to that cheaper insurance. And that's what we're going to have. That's the way, Jake, that you skip it. And of course, the full course, as I mentioned, you can check that out here. And the married put, you check it out radioactivetrading.com. You can check it out here at Power Options. And of course, we're always running the, this time of year, we're always running that end of year special bonus. You pick up the blueprint. It's an e-delivery cost. There's no shipping. It's $349, but you get these 8 special bonuses at the end of the year. 2 months of the Fusion subscription at a discounted value of only $10 per month. You get a couple of our free paid-for videos, the Foundations of Radioactive Trading, the 4 Insider Secrets of Trading, quick start guide, 1 month free to Power Options as well, email and customer support for free, and we have a variety of members-only webinars for Blueprint owners as well. You get access to. You can check that out more. Go to radioactivetrading.com or go to Power Options. Check out the products tab. Check out the blueprint. You can take a look at the table of contents right away there, Jake, and at the same time, you can also listen to the first chapter of the blueprint in audio format as well. As always, that end of year promotion ends at December 31st at midnight. So these special 8 bonuses are only available till then, but take a look at it, Jake. This is how you avoid missing out, in my opinion. Whoops, sorry, folks. Missing out, in my opinion, there with that proper structure, the married put structure, the married put default search, but the full insights on using the different management techniques, reducing the risk on the position from where we started. I start selling calls properly, not right away, but I start selling calls properly, following the rules in the blueprint. I'm going to generate premium. It's going to cut this risk down to maybe 90 cents, maybe 75 cents, maybe another call. I get it down to 10 cents. And what are we doing? We're closing the gap here in this red zone. We're generating income to lower this risk to where eventually, after I generate, say I take in $1.35 over the next 20 days using weekly options on CCL, for example, I knock this cost down to just say, I said $1.75, didn't I? So I knock this down to about $3.15, $3.20. Let's just call it $3.20, not $43.20, Mike. Let's call that $3.20. I'm generating income in 20 days, 25 days from now. For the next 370 days out, I've only got a risk of 13 cents or 0.6%. And what did I keep? The infinite upside profit potential. Getting to a point with low risk going through earnings, unexpected events. Who knows what Powell's going to say next? That's the advantage of this structure. That's the advantage of what's discussed in the blueprint, the full structure, full details, full insight, and of course, the 12 different income methods to use. And if your stock's going up as you expect, there's bullish income methods. If the stock stagnates, there's neutral ones. And if the stock falls, there's ways to readjust the position, taking advantage not only of selling premium and calls and different spread trades that are fun to do, but you've got a second working asset that's not going to zero. It's not a short-term put. You can manipulate that put option in your favor to get a better cost basis, get a risk reduction, and much, much more.